Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the Acca tutor, Mr. Jerem Tumkulu. In this video, we are going to touch on International Accounting Standards number 19, that is employee benefits. Right, this is part of our week 4 lecture series, where we will be looking at two international accounting standards, that is IASA 19, that is the current standard we are looking at, as well as IFRS 2, that is share-based payment. All right, so we're going to look at these two standards in this week 4. Remember, our course is just an 8-week course, and sometimes 6 weeks, depending on how things work out. Okay, so we are almost past the midway, and we need to finish this syllabus coverage in as quick time as possible. All right, now International Accounting Standard number 19, employee benefits, has been put across with the main objective of prescribing the accounting and disclosure for employee benefits. All right, so specifically, this standard requires us, or requires employers, to recognize a liability when an employee has provided service in exchange for employee benefits to be paid in the future. That's the purpose of this international accounting standard. So in that case, an expense has to be recognized when those services are given. Remember the matching concept. Matching concept. Okay. Now the matching concept says that an expense has to be recognized in a period in which the matching revenue is being earned or is being recognized. All right. So despite the fact that no payment has been made, but because a service has been given, therefore we have to recognize an expense. All right. Now we need to also appreciate the various types of these employee benefits. So there is a classification that is applicable in terms of International Accounting Standard number 19, where we have these employee benefits categorized or classified in certain classes. There is short-term benefits. These are the benefits that are paid in less than 12 months. For example, an annual bonus is actually a short-term benefit. Then we have the long-term benefits, which are going to be paid after 12 months. For example, bonuses which are payable every 5 years. Then there is post-retirement benefits. Okay, these ones now are the most common employee benefits which we are going to face in the Acca strategic business reporting exam. There are also other long-term benefits. We will talk about those ones at the end of the lecture, as well as the termination benefits, which we are also going to discuss at the peripheries. Now, when you're talking of termination benefits, in short, we are simply saying these are the benefits that accrue to employees after they are forced to quit their jobs. All right. So toward the end of the video, we are also going to talk about these termination benefits. Now, ladies and gentlemen, I want you to appreciate this pictorial where, for you to understand what will be happening on the post-retirement phase. Okay. During the employment of an individual, a company usually makes contributions to a pension fund. Okay, these are usually professional funds. Professional investment firms. And okay, all right, but um, I mean, these funds are usually run by professional investment firms. All right. So this fund is usually in two forms. Okay. The fund is usually in two forms. Okay. There is what is called a defined contribution plan or a defined benefit plan. All right. So whatever the plan, it receives contributions from the employer, which is the company. All right. Now, um, when the fund, okay, these companies, for example, in Zimbabwe, we've got Old Mutual. We've got Old Mutual. There's so many. There's also First Mutual and various pension funds that could be organized maybe by industry. For example, the mining industry workers pension fund, uh, the agricultural industry workers, or the Blawayo municipality workers pension fund, and so forth. So there are so many. All right. Now, what happens is these funds, when they receive money, when they receive money, they do not just lock it in the safe. It doesn't work like that. It doesn't work like that. When they receive the contributions from various companies, okay, they have to invest. Okay, they invest the monies uh, to other various portfolios, into other various portfolios. All right. Now, what happens now is that the investments are not always going to succeed. Sometimes they fail. You know, the business risks attached to whatever investment. All right. So the investments could appreciate in value or could depreciate. Now, the big question that comes is, who is going to bear the risks and rewards attached to the investment? Okay. So if we know the answer to that, then we are in a position to determine what type of plan was uh, was at play. We'll be able to determine whether this plan was a defined contribution plan or a defined benefit plan. We only know that if we realize whether it is the employee who is bearing the risk or the employer. Sometimes, even if the funds are put, um, even if the funds are invested and there are some gains or some losses, we will determine that the employee is going to suffer. The employee or another third party are going to suffer. Or we may also determine that the company that was making contribution is also going to suffer. So in those situations, we will be able now to determine who is, which plan is uh, under review. Now, the decision depends on the nature of the contract. If, for example, the employee bears the risk, then we call that arrangement a defined contribution plan. All right, it will be a defined contribution plan, okay, where the company or the employer is only liable for contributions made to the fund. Thus, investment risk is assumed by employee or third party like insurance. The benefit will depend on the assets of the fund. If fund has more assets, then the employee benefits more, or vice versa. So the advantage of a defined contribution plan is that when this particular investment goes up or appreciates in value, it means the fund also is appreciating in value. All right, and the employee is assured of more benefits. That's a defined contribution plan. All right, so what is actually defined in this arrangement, in the case of a defined contribution plan, what is defined or fixed is the contribution. The employers make fixed contributions to the plan. All right, they make fixed contributions to the plan. However, in terms of the benefit is going to appreciate or depreciate depending on the values attached to the investments. If the investments are gaining more money or more value, then the benefit that the employee is going to get is also going to appreciate or depreciate in value. But when we are talking of the defined benefit plan, we are saying that in this case, the employer or the company still has to bear the risk after making those contributions to the plan. He is going to face some investment risk. All right. So if he is going to face the investment risk, then we can safely say that the plan at play would be a defined benefit plan. The employer is unable to show that all actuarial and investment risk has been transferred to another party. So benefit in this case is normally a predefined formula, not solely linked to the amount of contribution. So you can see that as a departure from the defined contribution plan, which where the benefits depends on the appreciation in value of the investment. In the case of defined benefit plan, the benefit is not going to be unknown. The benefit is actually unknown because it is based on a predefined formula. For example, your benefit is going to be 10% of your last salary. That's what a defined benefit is going to be, or that's an example of a formula approach that is adopted in a defined benefit plan. So what is defined here is actually the benefit. So benefit is defined, whereas in this case contribution is defined. Please always understand this. What is defined in the defined contribution plan is the contribution. Okay, because normally these contributions are fixed amounts. But in the case of a defined benefit plan, what is defined is actually the benefit an employee is going to enjoy in future. Okay, you also have to know that in the defined contribution plan, the employer or the company that makes contributions is not liable to the investment risk. Whereas in a defined benefit plan, the employer or the company that makes the contribution is also going to bear the investment risk. Okay, that's it. Let's move on. Now, this is just a simple analysis of what defined contribution and defined benefit plan is. We have already pointed out that for a in a defined benefit, in a defined contribution plan, the company pays a fixed contribution, okay, into a separate fund, and has no further legal or constructive obligation. Once they remit the contributions, they are now free, okay. And then actuarial and investment risks of defined contribution plans are borne either by the employee or third party, that is insurance company. They are not borne or assumed by the company that is making those contributions. Now, when you are talking of the defined benefit plan, uh, the plans, these are all the plans, not uh, defined as contribution plans. Okay, so the International Accounting Standard number 19 specifically gives us a definition of the defined contribution plan, and any other plan that do not follow the defined contribution plan is defined as a defined benefit plan. Now, if an employer is unable to show that all actuarial investment risk has been transferred to another party and its obligations are limited to contributions made during the period, a plan is a defined benefit plan. Now, let's now talk of the accounting procedures whenever we are faced with these two plans. Let's start with the defined contribution plan. How do we account for whatever transaction that we enter into? Okay, whenever a company makes contributions, okay, contributions made are recorded as expenses. Okay, for example, if fixed contribution is 1.2 million dollars. Okay, if fixed contribution is 1.2 million dollars and is all paid up, the double entry would be debit expense 1.2 million and credit bank 1.2 million. Now, as usual, any unpaid amount would create a liability. For example, if fixed amount or fixed contribution is 1.2 million is above, but only $1 million is paid, the double entry would be we debit expense as usual 1.2 million because of the matching concept. Remember, even if we do not pay everything, we have to recognize the full amount of the expense. All right, so we're going to recognize the expense of 1.2 million. However, we are going to make two credit entries. The first entry is for the bank. We only paid 1 million, so credit 1 million. All right, and also the liability, credit payable. Okay, liability, which is a payable 0.2 million. So everything, if we are using a defined contribution plan, we are simply saying all expenses are expensed immediately to the statement of profit or loss. All right, and any outstanding payments would be a liability. All right, what about if we overpay? Okay, if we overpay, I need a different pen now. If we overpay, say the fixed amount was 1.2 million as usual, but we ended up paying 1.5. Say we pay 1.5 million. Okay, we are going to recognize the expense as usual, debit expense, our expense, that's 1.2 million, and the other common entry we can make is a credit bank. How much? 1.5 million. But you can see that our entry is not balancing. The debit and the credit are not balancing, and the debit are in deficit, so we need another debit entry. We debit what? In this case now, we need, for us to know what we are going to debit there, we need to rely on the definition of or maybe on the dictates of the conceptual framework. All right, we need to determine two things: either we are having an asset or an expense. All right, if we can recover the difference, that is the overpayment, which was 0.3 million, if we can recover, if we can prove that we are going to recover this 0.3 million, then we are going to recognize an asset. It is a receivable. But if we do not with sufficient confidence, if we do not have the confidence, or if we are not sure that we are going to recover the 0.3 million, then we have also to recognize another expense. Okay, so either we recognize an asset or we recognize an expense depending on the recoverability of the overpayment. Okay, so it is now balancing. Now that's what happens. Let us have a look at this particular example and see if we can make sense out of it. Duolingo PLC has payroll costs of $5 million for the year ended 31st December 2021. The company has a defined contribution scheme and pays pension contributions of 5% of salary costs each year. During the year, Duolingo PLC paid 0.2 million and had to pay over the balance in January 2022. Required account for this transaction. Now we need to determine the fixed contributions first. Okay, so the fixed contributions, fixed contribution. The fixed contributions are as is stated in the questions. Okay, the company has a defined, what's happening? I need another pen color. Okay, the company has a defined contribution scheme and pays pension contributions of 5% of salary cost. So 5% of salary cost. Okay, and the salary cost at, we are told they are 5 million. So 5 million. So every year we have to pay 0.25 million. Okay, as contributions to the plan. All right. So we are going to recognize an expense every year, debit expense of 0.25 million. Okay, and we have to credit how much? We only paid 0.2 million during the year, so we are going to credit bank 0.2 million. So there is an outstanding balance we are going to refer to as a payable, a liability of the difference, that is 0.05 million. So this is how we need to recall, we need to do to account for the transaction. That's how we need to recognize a defined contribution plan transaction. However, I want you to appreciate that in the SBR, the Acca SBR exam, there is no way, okay, it is quite rare that the examiners are going to tell you that the plan at play or the ensuing plan is a defined contribution or a defined benefit plan. You need to lead yourself using your accounting theory. Okay, this is the moment you need to appreciate this, you need to appreciate these plans at this moment during your study phase. Okay, this is why we are giving you this type of video, so that you enrich yourself with the required knowledge. Now let's move on to the defined benefit plan. Okay, as usual, the employee would be performing his services or providing his services during the employment phase. Okay, this is the moment the services are given. All right, and this is also the moment we are recognizing the expense. All right, then there is a particular point in time when they retire. This is the retirement phase. The employee leaves the organization and he is now entitled to what are called post-retirement benefits. Okay, and we say that in this case, the employer is also, the employer is going to bear the risk. All right, it's also going to bear the risk. All right, if those investments ended up failing, then it means that the employer would be faced with the consequences. All right, now when the employee is providing his services, okay, those services which he offers are expenses to the organization. We agree on that. Okay, they are expenses to the organization. However, they have got a technical term. All right, so those services which he offers are an increase in what is called a defined benefit obligation. Okay, when an employee provides services or his services to the employer, there is an increase in the defined benefit obligation. Those services create a cost, okay, or create an increase in the defined benefit obligation, and that increase is called the current service cost. Okay, they create what is called a current service cost. All right, so we recognize the expense as a current service cost, and it increases or they increase the um, defined benefit obligation. Okay, so whenever the employee is providing the services, we have to recognize the expense, despite the fact that we are not yet paying for those expenses, or we are not yet paying for those services. We are going to pay those services after he retires, but we have to recognize an expense which is called a current service cost, and this expense increases the defined benefit obligation. Remember, uh, this benefit obligation is going to be there because the payments or the benefits are going to be paid in the future. So it is actually a non-current liability, this defined benefit obligation. So that's what happens. Okay, so a current service cost, in short, is just an expense that has been allocated in the current year. Okay, so it is also an estimate. Okay, it is an estimate. All right, so if we pay, let's say we pay um, benefits from the fund, we are going to reduce the defined benefit obligation. Okay, so if we pay, uh, even if we pay for those current services that are being offered, if we pay any amount uh, in respect of those services, we are going to reduce the current service cost, but at the same time, we are going to reduce the defined benefit obligation. Okay, we'll be reducing the defined um, benefit obligation. All right, and an outstanding um, amount is also going to increase the defined benefit obligation. Okay, um, I think that is it. Let's move on and see if we can make sense of these issues. All right. Okay. So all the values, all the values are to be in present values. Okay, they're going to be in present value terms. All right, which means which means they will increase each year due to unwinding. Okay, when we are unwinding the discount rate, okay, the issues to do with unwinding. All right, um, where we would um, be trying to um, turn the figures, the present value figure, into the future value. All right, so we will be unwinding. All right, so the figure would increase every year. All right, now at the end of each year, okay, at the end of each year, um, the estimates, all right, at the end of each year, the estimates will be reassessed. Okay, will be reassessed. Remember, the current service cost is an estimate. this is an estimate. All right. So at the end of each year, the estimates will be reassessed. All right. And the liability recorded. Okay. As per the new estimate. Okay. As per the new estimates. For example, the planned asset could be 2 million at the start of the year, but at the end of the year, okay, it might be 3 million or 1.8 million. All right, that's what we mean. So we'll be adopting the new values which have been assessed. All right, but this fluctuation, okay, has to be accounted for. Okay, so there could be either a gain or a loss. So any gain or loss, is going to be a remeasurement. Gain or loss, and recognized in OCI, in the other components of equity. I mean, in the other comprehensive income section. All right, in the other comprehensive income section of the statement of comprehensive income. Okay, but now remember, we said that in a defined benefit plan, the employer or the company that makes contributions is also going to be liable for whatever risk on the investment, okay, of the fund, the fund's investment. So this company is not free from whatever happens to the investments of the fund. So there is an investment risk attached. So as the employer or entity, as the entity bears risk and rewards of the defined benefit plan. Okay, the funds will be treated as an asset. Okay, as an asset of the entity. So because we are going to suffer if the plan fails, or we are also going to benefit if it is successful. So this plan should obviously be our asset. We have to recognize the plan in our records as an asset. All right. Now, what of the interest payable or earned? Interest earned by the fund will be treated as income of the entity. Okay. Now, the converse is obviously true. Okay, the converse is obviously true. so we can't dwell much on that. Then contribution paid into the fund. Contribution paid into the fund will increase the fund. Okay, so obviously we have to debit. Okay, we debit the fund, we debit the defined benefit plan, and credit the bank. Because whenever we make contributions to the plan, we are increasing the plan assets. So we are going to debit the plan and credit the bank. Now, what of benefits paid? The benefits paid, remember, the benefits are going to come from the fund. It is not actually the company that directly pays the benefit, but it will be the fund that will be paying the benefits. So the benefits paid will decrease the fund or the plan. So in this case, we are going to debit the defined benefit obligation, because the obligation will be reduced as we make the payment for the benefit. As we give employees their benefits, it means that the defined obligation is being reduced, but at the same time, we are also reducing the plan assets. So credit plan assets. So the plan asset is going to be reduced with the benefit. So whenever the benefit is paid, it is going to have a two-way effect on the plan. It is going to reduce the defined benefit obligation as well as the plan asset. Okay, so to illustrate this theory, ladies and gentlemen, let us look at this particular example and see if we can make sense out of it. Okay, we've got this information of a defined benefit plan. All right, so let us use this information. Okay, so we have the present value of the defined benefit obligation on the 1st of January 2018, that is 10, and the present value of the defined benefit obligation at the end of the year of this March. Okay, so we can safely try to tabulate these things. All right, so you populate them like these ones are actually birds of the same feather. Then the plan assets, the fair value was at the beginning 130, 168, and at the end 294. Okay, then the rest we can attack them as we go. Okay, so we need to try to see how we can account for this defined benefit plan. All right, so we need a table like this one where we have, so these templates, ladies and gentlemen, we just have to be accustomed to them, because if we do not grasp the templates, do not cast them in our hearts, then we are going to be in trouble. So a table like this where we have the particulars, this is the defined benefit obligation column and the plan asset column, and then the net liability. Okay, by the end of the day, we must be able to have a figure for the net liability, which is actually required as part of the disclosures about the defined benefit plan in terms of International Accounting Standard number 19. So the net liability figure is actually required. All right, so the balance brought down for the defined benefit obligation that is at the start of the year was 210. So we need to slot in that figure as given. So we are having 210. And at the end of the year, we are having how much? We are having 378. So 378. Okay, remember all these figures are in millions. Right, and then for the planned asset, the opening balance was 168 and the closing was 294. So let us plot in these figures as they are. Okay, and then the interest income, let's slot that figure. Let's make some computations. Okay, this is just 10% of these figures. So for the DBO, that's 10% multiplied by 210. And for the planned assets, that's 10% multiplied by 168. Okay, so for the DBO, 10% multiplied by 210, that's 21. Okay, this increases the DBO, all right? It increases the defined benefit obligation, okay, and it also increases the planned asset. Okay, that's 10% of 168. All right, then let's go back to the question. The current service cost, all right, the current service cost, ladies and gentlemen, this one has a tendency, because remember I said the current service cost is an expense in that particular year, but it also is also going to increase our defined benefit obligation. So it has being an expense, okay, it has a tendency of increasing our defined benefit obligation. So let us slot in the current service cost of 63 here, because it is increasing our defined benefit obligation. Okay, so roughly the double entry in this case is actually going to be debit expense, okay, 63, and credit DBO 63. That's the respective double entry that is going to be made. All right. Now, let's see if we have got contribution that has been paid. Yes, we have got the contribution that has been paid. Now, when a contribution has been made, what happens is that we are going to have we're going to debit, okay, planned assets, because remember I said that whenever contributions are made, they are increasing the defined benefit plan. So we're going to debit, okay, debit plan asset and credit bank, because the bank has lost the money. All right, so let us account for the contribution paid. So the contribution paid, we are going to increase the plan asset 105. Okay, now let's see if there is a benefit paid. Okay, benefit is paid 20 million, and I say that when a benefit has been paid, it is going to reduce the defined benefit obligation as well as the planned asset. Okay, because benefits are paid from the planned assets, so obviously the money is left to the planned asset, so we're going to reduce the planned asset, but at the same time we have reduced the defined benefit obligation. So the benefit paid was how much? 20 million. So we are going to have a negative 20 and a negative 20. Okay, now the remeasurement, this one is a balancing figure. Okay, in this case, this one, it is a balancing figure. So let us now determine the net liability section. All right, but we can go to the net liability section before we determine the balancing figure for the remeasurement gain or loss. So let us use our calculators to determine what figure we can have as a balancing figure. Okay, so let us add 210 plus 21 plus 63 minus 20. We have got how much? We have got 274. Okay, 274. So it means that for us to reach 378, there has been some increase. So this one is an increase of 104. That's the balance. Okay, so we've got a positive 104. All right, and this positive simply suggests that there has been an increase in the defined benefit obligation. Okay, so what does this figure mean? Okay, an increase in the defined benefit obligation is actually a loss. Okay, it is a loss to us because it is an increase in a liability. That's an increase in liability. Now, what of the plan assets? Let us add those figures. 168 plus 16.8 plus 105 minus 20. We've got 2698. All right, and you can as well see that for us to reach 294, it means there was an increase. So minus 294, there was an increase of plan assets by 24.2 million. So this one, is it a gain or a loss? This one, because this is an asset, so there was a gain. Okay, gain or increase in asset. Okay, now we can safely do the net liability column. Okay, so for the balance brought forward, we are going to say 210 minus 168. 210 minus 168. That gives us 42. All right, and then we move on to the interest part of it. That's 21 minus 16.8. We have got 4.2. And then for the current saved cost, that's 63 minus 0, that's 63. Then for the plan assets, we are going to have a 0 minus 105. We are going to have a negative 105. Then here now, this one is the most interesting. Okay, the DBO has been reduced by 20, the plan asset has been reduced by 20. Are we going to have a negative 40 or we are going to have a 0? Obviously, we are going to have a 0. Then 104 minus 24, this one is going to give us 79.8. So let us add or subtract those figures. 42 plus 4.2 plus 63 minus 105 plus 79.8. We have got 84. This is the net liability. So 84 is our net liability. So what then happens with these figures? How do we record them? Where do we record them in our financial statements? Because by the end of the day, we need to be able to record them appropriately. It's not an issue of determining the figures, but it is also, it's not an issue of determining the figures only, but also to be able to post them or to account for them. We have to be able to account for the figures. Okay, so the interest cost. Let's talk of the interest cost first. Where do we put the interest cost? The current sales costs and so forth. All right, so the interest costs, okay, and current service costs are taken to the profit or loss. All right, then remeasurements, gain or loss to the other comprehensive income. All right, now contributions to the plan are credited to the bank. All right, then the net liability, the net liability the net liability increase from 42 to 84. Remember, we moved from this point to this point. Okay, from 42 to 84 will be taken to the non-current liabilities. That's an increase in the non-current liabilities. So in short, thus for the SPL, statement of profit or loss, we are going to have expenses. All right, so we are going to debit this we debit the SPL with the expenses of interest cost and the current service cost. All right, and from our computation, you can see that we are having this and that. Okay, so that's 4.2 and 6 and 63. So that's 4.2 plus 63. Okay, is equal to 67.2. We also have to take a figure, right? We have to take a figure to the OCI for the remeasurement gain or loss, and we are going to have what? Remember, this figure here is made up of this figure and that figure, so it's a difference. But the larger of the two figures was a loss. Okay, there was a loss of 104. All right, so obviously the ultimate figure, this ultimate figure is actually a loss. So it's a remeasurement loss. Being a remeasurement loss, we are going to debit the other comprehensive income. Okay, we are going to debit by that amount of 79.8 million. Okay, so we are having a debit, okay, because it's in the form of a loss. An increase in liability to us is a loss. All right, then what of the bank? What happens to the bank? The bank is credited with the contributions made. So we credit the bank with how much? 105, because we made that contribution. This 105, as you can see, that was the contribution that has been paid. And then there is, we need to account for the non-current liabilities. The non-current liabilities, okay, because we said that there has been a movement from 42 to 84, so that increase, so obviously the increase in a liability is a credit, which is a movement of 42 million. And we said this one is a movement, okay, from 42 to 84. The difference, that's 42 million, and that's what happened. All right, then lastly, we need to talk of the disclosure. So for the interest component, ladies and gentlemen, as you have seen, all right, okay, these are the notes to the statement of profit and loss and notes to the SFP and to the other comprehensive income section. So for the interest costs, the interest cost component, we are having let me use another pen. Okay, let me just first erase some of these, right? Because if I do not erase, it won't augur well. So, okay, for the interest, the net interest is this one, right? There is a net interest cost here because the larger figure, the 21, was for the defined benefit obligation. Okay, this is this one, and this was the interest on the planned asset. So we are having that figure there is actually in a form of an expense, the 4.2. So we are having a net interest cost of 4.2. And then service cost component was 63. All right, and if we total them up, we have got 57.2. And then in the statement of financial position, the notes to the statement of financial will show a present value of the defined benefit obligation. We take this figure, all right, the last figure, the closing figure, the 378, okay, as part of our disclosures, 378, and then the fair value of the planned asset at the end of the year was how much? Was 294. All right, so we replace these two figures and we get the difference, which is going to be the net asset or liability. In this case, we are having a net liability because, as you can see, the defined benefit obligation is larger than the planned asset value. So we are in a net liability position. Okay, then we have got the notes to the other comprehensive income section. All right, so the remeasurement gain or loss on the defined benefit obligation was how much? This was 104. Okay, so we slot in the figure 104. And the remeasurement gain or loss on the planned asset was how much? It was 24.2. And we are going to have the resultant 79.8. So these are the disclosures, ladies and gentlemen, which are needed in terms of International Accounting Standard number 19. All right, then let's move on to this aspect of past service cost. We have been looking at current service costs, which we said that these are the expenses allocated in each year. Okay, expenses allocated in each year are called current service costs. All right, but we have what are called past service costs. Past service cost is the change in liability due to change in pension entitlements. It may be either positive, where the pension entitlements are increased, or negative, where the pensions entitlements are reduced. Okay. So these changes could be in the form of, let's say, if we were saying your benefit is going to be based on 10% of last salary. All right. And then the employee gets promoted. All right. If the last salary was 400,000 when the plan was started, and then the employee gets promoted and is now earning 1 million, you can see that there is need for some adjustments, as 10% of 1 million would be 100,000. All right, whereas it was initially 40,000. So those are the changes we are talking about. All right, so all past service costs are recognized in statement of profit or loss immediately, so they are also part of the service cost component. This is a change in accounting estimate and treated prospectively. So in short, past service costs are a change in liability due to change in pension entitlements. Now, decrease in employees in the plan. If decrease is not substantial, then we have to treat it as a past service cost. All right, but if the decrease is substantial or material, we will call it a curtailment. All right, there will be a curtailment. All right, now how do we treat a curtailment? All right, curtailments can either be with settlement or without settlement. Remember, the issue of decrease in employees in the plan is something that is very common with the empowerment of employers these days. The Labor Act actually allows them to fire employees whenever they feel that their operations are no longer compatible with the employees. So they fire, they make employees redundant and so forth. All right. So when employees are made redundant, automatically the plan assets is going to be, the plan is going to have fewer employees because some would have been made redundant. So it is now an issue of numbers. Okay, how significant was the reduction? If the reduction is insignificant, we need to treat that incident as a past service cost. Okay, and we have been told that past service costs are expensed immediately to the statement of profit or loss. However, if the reduction is significant, we then have to treat the incident as a curtailment. Now, curtailment is in two forms. Okay, it's in two forms. If we are not paying anything, if we are not paying any cash, then we have to debit the defined benefit obligation, all right, and credit again, credit profit or loss. All right, we are not going to pay anything. So in that case, there has been a gain. Okay, there has been a gain. But if we are paying, there are two possibilities. Either we are overpaying or underpaying. It's not uncommon. Okay, it's not common that we are going to pay um, the amount that is equivalent to the rightful amount. Usually we are going to overpay or underpay. Okay, it's very rare to have a situation where we just pay the exact amount as required. Usually we are going to underpay or overpay. Now, if we overpay, we have to debit the defined benefit obligation, debit the loss on settlement, and credit the plan assets. All right. Remember, the plan asset is always going to be credited. Why? Because we'll be paying from the plan asset. So we are going to reduce the plan. Remember, the plan is an asset. All right. So to reduce an asset, you credit it. All right. Now, if we underpay, then we have to debit the defined benefit obligation. So you can also appreciate that in either case, in all these cases, the defined benefit obligation is being debited. Okay, so by curtailing, we are reducing the obligation. So automatically we are debiting the obligation. All right. But whenever we are paying, therefore, the plan asset is going to be reduced because we'll be paying from the monies of the plan. Okay, we'll be paying from the monies of the plan. So that's what will be happening. Now, if we underpay, we debit the defined benefit obligation to reduce it, and then we have to credit the plan asset to reduce it, and also to credit the profit or loss because there will be a gain on settlement. Okay, let's look at this particular example and see what would be happening. Radio PLC decides to close a business segment. The segment's employees will be made redundant and will earn no further pension benefits after being made redundant. Their plan assets will remain in the scheme so that the employees will be paid their pension when they reach retirement age. This is a curtailment without settlement. Before the curtailment, the scheme assets had a fair value of $500,000 and the defined benefit obligation had a present value of $600,000. It is estimated that the curtailment will reduce the present value of the future obligation by 10%, which reflects the fact that employees will not benefit from the future salary increases and therefore will be entitled to a smaller pension than previously estimated. Required. What is the net gain or loss on curtailment and how will this be treated in the financial statements? Okay, so this is the information which we have been given. All right, so in short, the obligation is to be reduced, remember, by 10%. All right, because this statement is telling us that the defined benefit obligation is to be reduced by 10%. Remember, the obligation was 600,000. All right, so it is going to be reduced by 10% of 600,000. this is going to be 60,000 reduction. Okay. However, there is no reduction with regards to the plan assets. They will remain at 500,000. Right, the plan asset is not going to be affected by this reduction. So the reduction in the obligation represents a gain on Ketones, okay, which should be included as part of the service cost component and taken to profit or loss for the year. So the net position of the plan following the Ketones can be presented as follows. So we have a situation where we are having the before Ketones, then on Ketones, and then after Ketones. Okay, these are the two situations. I mean, the three situations we need to consider. Remember, our figures are in thousands. Okay, I don't like this pen. Let me use a much darker one. So we are having the present value of the defined benefit obligation. All right, at the start it was 600,000. All right, and then the fair value, sorry, the fair value of the plan asset was 500. So obviously we are having this should be the net DBO, okay, in the SFP. That's the net defined benefit obligation. Okay, so this was the issue before any curtailment. All right, but on curtailment, we are told that the defined benefit obligation is going to be reduced by 60,000, as we have just calculated, because 10% reduction, that's 60,000. Okay, because we have put zeros there, no need to put other zeros. So that's 60,000. What's going on with my marker? Oh man, these markers, whenever you try to, I'm sure you guys are, oh, I'm sure you guys are seeing that this is just a skisting. Okay, that's a skisting. All right, now in terms of the curtailment is not going to affect our plan asset, so there is a zero impact. So obviously here we are going to have a negative skisting. Then proceeding, we are going to have a 540 impact. What's going on? Sorry, this pen of mine, when it starts to misbehave. Oh, it can't erase, it's refusing. So ladies and gentlemen, I guess you guys can still appreciate that this is a skisty. All right, that's a skisty. Let me just put a minus sign. All right. Oh my gosh. Sorry guys. Oh, I'm sorry, my solution is misbehaving, but I'm sure you guys can see a skisty on the corner there and a negative skisty, and that's my wish, ladies and gentlemen, that you are going to see that. Okay, so here we are having a 500. Okay, the 500 has been taken from this. This is the same 500, because here there's no impact, there's a zero impact there. So obviously we are having that 500 as it is on that end. Oh man, it's refusing. All right, so here we have the 40. All right, so this simply means that we are going to have a gain. All right, there is a gain on Ketones. The gain on Ketones is 60,000. All right, we are having a gain. Why? Because there is a reduction. All right, there is a reduction in the defined benefit obligation. It started as 600,000, as you can see there. All right, started at 600,000. However, it ended up being 540. All right, please just ignore the movement of the pen. I don't know what's happening. All right, so there is a 60,000 gain. All right, and this should actually form part of the service cost component in the statement of profit or loss. So this is actually a gain. The 60,000 is a gain. So this simply means that the net defined benefit obligation, which had started as 100,000, is now 40,000. So the 40,000 is actually going to be recognized in our statement of financial position as the net benefit obligation. Okay, so we have made a gain of $60,000. All right, let's try this other example and see if we can make sense out of everything here. All right, and I think we're gonna rest our case after this example. All right, we have the information as usual. Okay, we have the information as usual. We've got the PV of the defined benefit obligation at the 1st of January of 2010. We also have the PV of defined benefit obligation at the end of the year of 378, and then the fair value of plan assets at 1st January of 2013 of 168, and the PV of plan assets at 31st December of that March. Then we have got current service cost of 63 million. All right, so this is just the same information. However, we are told that at the start of the year we had past service cost of 21 million and the total contribution is 205. Then the benefits paid at the beginning of the year were 20 million. All right, then there was Ketones and settlement, and then discount rate is still 10%. All right, now there's going to be some modification in the way we are going to do to compute our interest component because of the new costs that have come into play, and which were of whose figures we are told that at the beginning of the year there were so much. So this involves the past sales costs as well as the benefit that has been paid. Okay, so let us first do our table before we do the rest. All right, so as usual, you can, if you know, if you can produce this template in the exam, you can just slot in the figures, and then we negotiate. You worry about the rest that needs some computations. All right, so um, the the figures brought forward, the balances brought forward for the DBO was 210, and for the planned asset was 168. So 210, 168. Okay, and then the closing balances were 378 and 294. Okay, then the interest cost, like as I've indicated, the interest cost is going to be affected. It's no longer an issue of just multiplying 10% multiplied by 210 or by 168. It doesn't work like that. When we now have past sales costs into play, which have come into play, we then have to put them into consideration as well. So we are going to say 210 plus 21 dollars, which is the past sales cost, less the benefit that has been paid, and then we get our value for the DBO, that is 21.1. And then we are also going to say for the planned asset, here we need to put into consideration the benefit that has been paid, and because why? If you look at this, the past sales cost figure was at the first of at the beginning of the year, which means for the current year, we need to also consider that amount. Because remember, we are making accounts at the end of the year. So we need to put into consideration the current year's, the charge that is to be considered. All right. So at the beginning of the year, remember, the past sales costs have to be expensed as they are incurred. All right. So the past sales costs, remember, are due to a change in the entitlements of employees. So when we discover that the employees are now earning so much, or they're now earning, they've got an increase in their earning, in their future earnings, then we need to consider that. So the values for this at the beginning of the year have to be adjusted, taking into consideration the sales cost. So which means we have to increase, because the sales cost has come into play, so we have to increase the opening values with the past sales cost. But we also have to reduce that figure, with the benefit that has been paid. So this is why I'm saying you need to say 210 plus 21, 210 plus 21 less 20, which is the benefit that has been paid, and you're going to have your 21.1. However, in the case of the planned asset, we need now to put, to consider the benefit that has been paid as well. So we then have to say 168 less 20 multiplied by 10%, and we have to get 14.8 as the payment. As the interest end or interest income. Okay, now the current sales cost from the question, the current sales cost, we just have to take it as it is, the 63 million. Then the past sales cost, we have talked about it as 21. Okay, it's just 21 million. Then the Ketones and settlement. We are told that there is Ketonement of 5 million and settlement of 6 million. So that's 5, okay, and 6. Ketonement, remember, is a reduction, a significant reduction in the employees, right? And then it is in two forms. There could be ketonement without paying, and then ketonement with paying. That's when we have the issues to do with settlement. Now, the settlement is going to reduce the plan asset, all right? Whereas the ketonement on its own might be without settlement, as in this particular case, it is without settlement. So this is why we have put the 5 under the DBO. It is going to reduce the defined benefit obligation. However, when there is settlement, then the plan assets are going to be affected. Okay, the plan assets are going to be affected. Then the benefit paid, the contribution paid, this is 105. Okay, contribution paid increases our plan. Okay, it increases the plan, so it is going to be positive. Then the benefit paid, now this one reduces both the plan and the DBO. Okay, how much was paid? 20 million. Okay, all right, on my pen now. Now let's determine the balancing figures there for the remeasurement gain or loss. To use our calculators, we can see that there is need for an increase. There was an increase in the liability, the defined benefit obligation of 87.9, and there was a decrease as well in the plan assets of 32.2. Okay, so once we have determined this, we then have to compute the net liability, which is just the difference of these two figures. So, for example, the balance brought forward for the DBO, and the differences of the balance brought forward for the DBO and plan asset. That's 210 minus 168, and we get 42 as usual. And then here we get 6.3, right? And here that's 63. And for the past sales cost, okay, we get our 21. And here the ketonement and settlement. All right. Ladies and gentlemen, I want you to appreciate one thing here. All right. If we get back to our ketonement here, we are saying that ketonement can be either with settlement or without settlement. If they are not paying, if we are not paying any cash, we debit the defined benefit obligation and credit gain on ketonement. All right. Then, if we are paying, two possibilities exist: either we are overpaying or underpaying. All right. So, we debit the DBO if we are overpaying, or if we have overpaid. We debit the DBO and debit loss on ketonement. All right. If we underpay, we just do the opposite. All right. But in all of these cases, the defined benefit obligation is being debited. So the trick here is that we are given this information, curtailment and settlement. This is almost like one thing, all right? It's almost like one thing in the sense that the settlement figures, the $6 there, is actually showing that there was curtailment, right? There was curtailment, but we paid in excess over $5. Okay, the curtailment itself is $5, all right? But there was also an extra settlement of $1. Okay, so there was an extra payment of $1. So when we come here, we are going to have the final impact, which is the excess of $1. Okay, so minus 5 minus 6, we are going to have minus 5 minus 6, we're going to have a plus 1. Okay, but I don't want you to look at this table with that mathematical mind, but I want you to have a look at the table with the understanding. Okay, you need to understand the table as an accountant. All right, I'm saying that when we are talking of curtailment has an impact of reducing both the defined benefit obligation as well as the plan asset. But you also have to appreciate that when there is curtailment and settlement, all right, there is an impact that the settlement will be the surplus, okay, would be the monetary payment that has been made. Okay, so basically we are saying here that the curtailment was 5 million, okay, and the curtailment determines the benchmark. So if we are told that the curtailment was 5 million and the settlement was 6 million, then obviously there's been some excess payment that has taken place, okay, and the excess is determined by the difference between the two figures, and it means that we paid 1 million more, all right, and this is going to reduce our plan assets, all right? So the loss there is actually the 1 million, all right, and here we are having negative 105, and there we are having a 0, okay. The reason why I put a 0 there is because we are not actually be in the same position with this one, right? But I want you to look at it this way. We are having a defined benefit obligation that has been reduced by 20 and a plan asset that has also been reduced by 20. The impact there, all right, the impact there is going to be a 0. But you can as well go mathematical. If we are having minus 20 minus 20, obviously this is going to be 20 plus, minus 20 plus 20, and you're going to get a 0. So this is the same thing that is happening here,
But I don't want you to understand it mathematically. I want you to understand it from the accounting sense. The defined benefit obligation has been reduced by 20. The plan asset has also been reduced by 20. These figures, this one is a negative and this one is a plus. Alright? So obviously the movement on the negative is equal to the movement on the positive. Then the resultant impact is going to be a 0. So this is why we are putting a 0 there. Then 87.9 minus 32 we are going to have 55.7. Okay, then let us determine the difference between 378 and 294, and we get our 84. Alright, now the question could be, where do we then have to put these figures? So, okay, these three figures are going to be taken. Let me just say 4. They are now 4. That one is to be accounted for as well. These are going to the profit or loss. Alright, they're taken to the profit or loss. Alright, and then this one is credit bank for the 105, because this is a contribution to the plan. And then this figure, the 55.7, is taken to other comprehensive income. Okay, so basically in short, all these are going to be accounted for as follows. We're going to debit profit or loss with 91.3. 91.3 is those first 4 figures. I said 6.3 plus 63 plus 21 plus 1. Okay, those figures. Alright, and then we are also going to debit the OCI. Okay, the OCI with 55.7. Why are we debiting the OCI? Remember, the figure was, the head figure there was 87.9, which was a loss, because an increase in liability is a loss to us, and then there was a small gain on the plan asset. So automatically this is a loss. Okay, this is a loss. So this is why we are debiting the other comprehensive income. Then we have to credit the bank with 105, and we credit the non-current liabilities with 42. Where did we get the 42? The 42 is there. Alright, and then we do the disclosures. For the disclosure, we simply have to say notes to the profit or loss account. The notes to the profit or loss account is going to have the net interest cost. The net interest cost was 6.3, if you still remember. Okay, 6.3, that one. And then the current service cost was 63, and then past service cost 21, and then the loss on settlement was 1. If you add them up, you get a total of 91.3. which has to be expensed to the statement of profit or loss. Then note to the SFP. Our SFP is going to have the present value of the DBO, defined benefit obligation, that's 378, which is a figure, the closing figure of the DBO, and the closing figure of the plan asset is 294. We have to deduct that figure. The fair value of the plan assets, 294. So we are going to have a net liability of 84. Net liability. Then let's talk of the last issue, the disclosures in the notes to the other comprehensive income. Okay, here we're going to have the remeasurement. Remeasurement loss on DBO. This was 87.9, and the remeasurements gain on plan asset or plan assets, which was 32.2. Then we have our 55.7. Okay, I think that was it. All right. Now, there are some issues like asset ceilings and so forth. Those ones we're going to cover them in our future videos. Okay, should we get the chance and opportunity? But in asset ceiling, we are simply saying that sometimes we might consider a plan as worth this much, when in actual fact we are operating below that value. Okay, so an asset ceiling is just a way of saying we need to report in terms of the substance over the form. We need to report the substance over form. So usually what happens is these defined benefit pension plans, they usually run in deficit, all right, where the obligation would be exceeding the plan assets. All right, so in that case there won't be much problem. However, some of these pension plans would be showing some surplus. All right, now if a defined benefit plan is in surplus, then International Accounting Standard number 19 states that the surplus must be measured. Okay, let me try to find. All right. If the defined benefit plan is in surplus, then the surplus should be measured at the lower of the amount calculated as normal per earlier examples, okay, and the total of the present value of any economic benefits available in the form of refunds from the plan or reductions in future contributions to the plan. Okay. Okay. So, as you have seen in the previous previous examples, we were resting our cases with a net, in a net liability position. But it's very rare to have a net asset position, all right, because
in that case, we will be having the surplus. All right. So we are being restricted by International Accounting Standard number 19 that that surplus should actually be measured at the lower of the amount calculated as normal and the total of the present value of any economic benefit available in the form of refunds from the plan or reductions in future contributions to the plan. So in other words, this principle ensures that the surplus recognized in the financial statement meets the definition of an asset, which is a resource controlled by the entity that will lead to a probable inflow of economic benefits. All right, let's have a look at this one example and uh, probably rest our case. The following information relates to a defined benefit plan. The fair value of the plan assets was 950, present value of pension liability 800, present value of future refunds and reductions in future contributions that's 70,000. Required. What is the value of the asset that uh, is recognized in the financial statements? All right. So we just have to come to our drawing board and say the value to be recognized is the lower of, okay, this should be the lower of remember our figures are in thousands, so that's the lower of the present value of plan obligation. Okay, the plan obligation, from the figures there you can see that this should be 800, so 800,000. All right, fair value of plan assets 950, so we have this figure. All right, and then we are told in the question that the present value of future refunds and reductions in future contributions is 70. So fair value of future refunds and reductions in future contributions is 70,000. So the lower of this is also negative. So the lower of this and this. All right. So you can see that the lower is actually 70,000. Remember, there these figures are put in negative. The negative function, operation there doesn't mean that they are liabilities or expenses, but it simply means that we want to demarcate, to make the difference. Remember, the liability was 800 and the asset was 950. Okay, so the 150 here is an asset. So obviously, this 70,000, since it is an asset, it's better for us to put it in negative. However, when you are comparing, just have to ignore the bracket and actually assess the figures without bracket. So the lower of the two figures, 150 and this is 150,000. 150,000 is 70,000. The lower is 70,000. So the plan, this particular plan, should be recognized at 70,000, because 70,000 is actually the present value or the fair value of the future refunds and reductions in future contributions for this particular plan. So we need to recognize the plan at the 70,000 value, which is lower. Okay, that's it for. So I promised that I would discuss further issues related to other long-term post-employment benefits. So let us discuss those ones, and as well we can discuss about termination benefits, and we rest our case. Okay, other long-term benefits. Other long-term benefits include the following items. Okay, if not expected, I mean, as I've indicated in the initial part of this video, I say that other long-term benefits are those benefits which are not expected to be settled within 12 months, okay, after the end of the period in which the employee renders the related services. So they include the long-term paid absences such as long service or sabbatical leave, okay, jubilee or other long service benefits, long-term disability benefits, profit sharing and bonuses, and deferred remuneration, right? But how do we have to account for these? The bottom line is, as long as, as other long-term benefits are not subject to so much uncertainty as defined benefit plans, the accounting treatment is a bit easier. However, the entity should perform the same steps as have been described at defined benefit plans. The only difference is that all items such as sales cost, net interest on the net defined benefit liability asset, and remeasurements of the net defined benefit liability are presented in the profit or loss, so nothing goes to the other comprehensive income. So you can see as well, or you can appreciate as well, that when you are talking of the accounting of other long-term benefits, we are inclined toward the defined contribution, okay, the defined contribution plan, all right, because that's the plan that usually does not put, okay, that plan does not consider the use of the other comprehensive income section of the profit or loss. All right. So basically, the defined contribution plan would be dealing with this issue, but doesn't mean that it is always the case that you have to account for these for these other long-term benefits using the defined contribution method or approach. Okay, because remember, these defined, these plans are subject to contract. So sometimes, for example, the payment of a sabbatical leave doesn't necessarily mean that it has to be accounted for as a defined contribution plan, okay, because there won't be any contribution that has been made by the employer, okay, but it is a benefit that somebody could be entitled to. So it doesn't mean that they have to be outright treated as defined contribution plans. No, it doesn't work like that. All right. So basically, this is what happens. Now let's look at termination benefits. Termination benefits, as I've already indicated, are those benefits that are going to be provided to employees who have been forced to leave their jobs. Okay, So the difference here in the treatment of termination benefits is that they are not provided in exchange for the service of the employee. Instead, they are provided in exchange for the termination of the employment contract. Okay, so they are actually different from most of the benefits we have been discussing so far. However, we need to be careful here because the termination benefit sometimes includes the benefit for both the termination of employment and the service of employee at the same time. For example, a company closes one of its production plants and offers the bonus of 1,000 USD to all employees who will be laid off. But because this company needs qualified people to perform the closure, it offers the bonus of 3,000 USD to each employee who stays with the company until the closure is completed. In this small example, the bonus of 1,000 USD paid to all fired employees represents termination benefit, and additional 2,000 USD paid to all employees who stay until the closure is completed represents the benefit for the employee's service, mostly classified as other long-term benefits in line with International Accounting Standard number 90. So how do we have to account for the termination benefit? The primary question here is when to recognize the liability and expense for termination benefits. It is at the earlier of when the company can no longer withdraw the offer of those benefits. Either the termination plan exists or employee accepts the offer of benefits, and when the company recognizes cost for a restructuring, that is the National Accounting Standard number 37, involves the payment of termination benefits. The next question is how to recognize termination benefits. This depends on the specific terms of the benefits. If the termination benefits are expected to be settled wholly for 12 months after the end of the reporting period, then we should apply the requirements for short-term employee benefit to recognize it as an expense to profit or loss on a discounted basis. If the termination benefits are not expected to be settled wholly before 12 months after the end of the reporting period, then we should apply the requirements for other long-term employee benefits. So recognize it as expense, profit or loss on discounted basis. Okay, I think we need to look at this particular example. This is a past exam question from the SPR specimen paper. Okay, example Kutchen, question Kutchen. Alright. Kutchen has decided to restructure one of its business segments. The plan was agreed by the board of directors on 1st October 2006 and affects employees in 2 locations. In the first location, half of the factory units have been closed by 31st December 2006, and the affected employees' pension benefits have been frozen. Any new employees will not be able to join the defined benefit plan. After the restructuring, the present value of the defined benefit obligation in this location is 8 million. The following table relates to location 1. So you can see that in this particular question already we are being taken to the issues to do with Ketones. Okay, because there is a significant reduction in the employees in the plan, because the plan, as you can read here, in the first location, half of the factory units have been closed by 31st December 26, and the affected employees' pension benefits have been frozen. Any new employees will not be eligible to join the defined benefit plan. After restructuring, the present value of the defined benefit obligation in this location is 8 million. The following table relates to location 1. So the table itself tells us that the present value of the defined obligation was 10 million. However, it is going to be reduced to 8 million. is synonymous with Ketones. All right. So obviously, the reduction in the defined benefit obligation is going to be a debit on DBO, okay, of how much? 10 minus 8, that's 2 million. All right. And we are going to credit profit or loss, 2 million. All right. Why are we crediting profit or loss? Because this is simply a Ketones with without settlement. All right, it's a Ketones without settlement, so it's actually a gain to us. So we are reducing the defined benefit obligation and at the same time uh, enjoying a gain. All right, if you can just replay the video on Ketones, we say that when there is no settlement, then you have to debit the defined benefit obligation and credit gain on Ketones. Now, in the second location, all activities have been discontinued. It has been agreed that employees will receive a payment of 4 million in exchange for the pension liability of 2 million in the unfunded pension scheme. So here we are being told that there is a creation of new liability, right? There has been a, a pension scheme. However, this was not funded. All right, there was no a formal plan. All right, either defined contribution or defined benefit plan. They were non-existent. All right, but okay, the plans, although they were in existence, um, there was no use of a professional fund. All right, there was no use of a professional fund. All right, but the company was actually maintaining on its own. It was maintaining. So it is now agreeing that the employees uh, who were part to this plan are going to receive a settlement or are going to receive a payment of 4 million. This payment is a settlement. So there is Ketones with settlement in this case. There is Ketones with settlement. So what happens? The DBO was 2 million. Okay, DBO was 2 million, but we are going to overpay. This is an overpayment. Okay, 4 million there is actually an overpayment. So what is the double entry here? We're going to debit the DBO as usual. Debit DBO, so DBO 2.4 million because we are reducing this liability. All right, and we are going to credit payable because we haven't paid. We can't credit the bank because it hasn't been paid. So it's a future payment. So there's a future payment of 4 million. All right. So we need to make another corresponding debit entry to make sure that this account comes to 4 million. I mean, the debit side comes to 4 million. So we're going to debit something else. And this one is the profit or loss. We're having a loss, an extra payment of 1.6 million. Okay. So as you'll be attacking the question in the exam, make sure to do these double entries. They might help you to understand what is going on. Then, Kutchen estimates that the cost of the above restructuring, excluding pension costs, will be 6 million. So, excluding the pension issues, the restructuring exercise itself is going to cost 6 million. Kutchen has not accounted for the effects of the restructuring in the financial statement because it is planning a rights issue and does not want to depress the share price. Therefore, there has been no formal announcement of the restructuring. Now, the question is saying, discuss with suitable workings how the pension scheme should be dealt with after the restructuring of the business segment and whether a provision for restructuring would have been made in the financial statement for the year ended 31st December 2026. Now, when you are talking of the provision for restructuring, this is an item of IAS 37, provisions, contingent liabilities, and contingent assets. Okay, that's the accounting standard. And we know that for us to recognize a provision for restructuring, two conditions or two criteria have to be met. Okay, two criteria have to be met. Okay, the first one is there should be a formal plan which has to be approved by the board of directors. Okay, and then this should be announced to affected parties. Okay, so the formal plan has to be there, has to be prepared and approved by the board of directors, and then it should be announced to affected parties. All right, which means they should be quite aware that such a restructuring exercise is taking place. Now, given the situation, we are told that the plan has been agreed. Sorry, the plan has been agreed by the board of directors. So obviously, it is the plan that has been approved. But in terms of announcement, can we simply say this plan has not been announced? We are told actually that it is at the implementation stage by the year end. So obviously the announcement has been done or is irrelevant in this particular issue or case because the restructuring exercise is at implementation stage by the reporting date. So obviously this provision should have been met. Okay, because of this fact, the provision should have been met. So how do you answer? How do you structure your answer in the case of an SBR exam? Because that's where most students find it challenging. The first thing you have to do is you have to understand the rules of the accounting standard. What does the accounting standard say about a particular issue? Then you have to relate that issue. You have to relate the rules to the scenario. You have to relate the rules to the scenario so that the markers will see that you are not simply waffling material you have copied from the textbook. Then you have to make the conclusion. The conclusion, an example of a conclusion is to actually give your opinion as to whether the restructuring provision should have been made, as to whether the restructuring provision should have been made in the financial statement. Okay, because the question is saying, tell us whether this provision should have been made. And you must actually conclude by saying, based on these facts, a restructuring provision should have been made or should not have been made. Okay, so let's try to write a definitive answer to this question. So our solution should be like this. In terms of IAS 19, where there is a substantial decrease in the number of employees in the post-retirement benefits plan, it is treated as a case of curtailment. Where the defined benefits, obligation is reduced by the decrease in liability, and the fund is decreased by the amount paid from the fund and any overpayment or underpayment is recognized as a gain or loss in the profit or loss account. All right, that's the rule. Okay, that's the rule part. All right, you then have to proceed to the application. In case of Kutchen, in location 1, there is curtailment without settlement as half of the factory units have been closed with affected parties. I don't like parties, let's say employees, with affected employees, benefits frozen. So the employees in this particular location have had their benefits closed. Okay, but remember, we are talking of half of factory units have been closed. So this is significant. Is significant. Because for a case to be considered a curtailment, it should be a significant issue. Otherwise, we just have to treat that issue as a past service cost. Remember that. And when we are treating it as a past service cost, then we have to expense it as it occurs. Um, initially, uh, the present value of the DBO, that is the defined benefit obligation, was 10 million. Okay, reduced to 8 million. Therefore, okay, in the exam, we don't have to put those dots, just have to write the full therefore um, we debit the DBO with the difference, that is 2 million, and credit the profit or loss or retained earnings as a gain, 2 million. Okay, now with regards to location number 2, as regards location 2, there is um, a Ketones as or liabilities will be um, extinguished. All the liabilities will be cleared, okay, by the payment of 4 million. However, you should realize that this settlement is with settlement. The settlement is therefore with settlement, and this shows that Kutchen has overpaid. Therefore, there is a loss of 1.6 million, given by 4 million minus 2.6, 2.4 million. The following entry is relevant. Okay, so you must show the examiners that you are ready to pass, you are ready to go to the next paper. So this should actually be flowing. They should be like, accounting should be like a stream flowing, overflowing, okay, in you. So the following entry is relevant, where we are going to say we debit, okay, we're going to debit DBO with how much? The amount of the liability, 2.4 million, and we are also going to debit profit or loss, because there's been a loss there of 1.6, and we are going to credit the payable. So this is a future payment which we are going to pay. Now, with regards the cost for restructuring of 6 million, all right, you can proceed by arguing that you first have to speak of the rules. in terms of International Accounting Standard number 37, don't worry about the numbers of these accounting standards. If you are doing the Acca SPR paper, there are no marks for those numbers. Okay, if you have forgotten about the accounting standards number, don't worry. Okay, you're not going to miss a mark because of that anomaly. All right, but if you can simply state the International Accounting Standards and its name, the number and its name, to show the examiners that you are ready, you know what you are doing. Okay, so in terms of International Accounting Standard number 37, that is provisions, contingents, liabilities, and contingent assets. Don't worry about the section. Don't worry about that. You're not a lawyer. All right. So you don't have to say restructuring provisions can only be recognized when two criteria are met. That is, when there is a formal plan that has been prepared and approved by the board of directors, and this plan has been communicated, has been announced effectively to the parties concerned or through their representatives. All right. In the case of Kutchen, it has been stated that the the plan had been agreed with the board of directors on the 1st of October. Okay, what was the date? For the question, you just have to be yes on the 1st of October. So that's when the plan had been agreed. So this means that the first criteria has been met. Now, in terms of the announcement, we are also told that the restructuring exercise was at the implementation stage by the year end, which means every employee was now in a position of knowing what was going on. So therefore, a provision of 6 million should also be made at the end of the year. Then you rest your case, you get your marks. So this is actually simple, ladies and gentlemen. It's not rocket science. So I hope, ladies and gentlemen, you've been assisted tremendously from this video, and I look forward to have you guys subscribing to the channel, to like, to share the video, to make some comments so that we improve, so that others can benefit as well. All right, so this is your chance, ladies and gentlemen, to be taught accounting right on your doorstep. Okay, and remember, the Acca tutor is just an email or a phone call or WhatsApp away from you. So do not feel or do not walk this Acca journey alone. Never walk alone. You must have your tutor by your side. So until next time, ladies and gentlemen, may you continue to feel excited. Let me just say, very, very excited. I, the Acca tutor, am signing out. Goodbye.